You've been sold a story, a way to turn a small stake into a fortune. The dream is the product.
That story is a lie, a very carefully constructed, expensive lie, and you are the liquidity. Forget chart patterns, forget luck. This is the structural reality. Stop, look at the math.
On my desk, we don't guess. We price the fear you're willing to overpay for.
Welcome to the paradox, where being right is the most expensive mistake you can make. Right move, zero profit. Why?
Secure your edge. Click subscribe to master the professional side of the trade.
You've been sold a story that the options market is a path to wealth, a way to turn a small stake into a fortune. That story is a lie, a very carefully constructed lie. We're not going to talk about chart patterns or trading setups today. We're going to talk about the brutal, structural reality of the game you're playing. Forget about bad luck, forget about being wrong on the direction. The truth is, the moment you, as a retail trader, click the buy button on an option, you've already accepted a position with a negative mathematical expectation. You've entered a game where the house edge isn't just a risk, it's a built-in feature of the system. Let's pull back the curtain and see why. We're not going to start with sentiment or some guru's opinion. We start with the cold, hard math. Because the numbers don't have an emotional bias. And frankly, they paint a very bleak picture for anyone who consistently buys options. You see, on my desk, we don't think in terms of simple wins and losses. We think in terms of risk-adjusted returns. The metric for that is the Sharpe ratio. Now, research from places like AQR Capital Management is pretty clear on this. A strategy of constantly buying options for protection, well, it yields a Sharpe ratio of about 0.14. To put that in perspective for you, just owning the S&P 500 index gives you a Sharpe of 0.32. You are literally paying to take on a strategy that performs worse on a risk-adjusted basis. And us, the sellers, we're on the other side of that trade, collecting those payments. So what's the engine that drives this whole thing? It's a concept called the Variance Risk Premium, the VRP. The simplest way to think about it is, it's the price of fear. People are fundamentally willing to overpay for insurance against a disaster. This overpayment, this premium, is a persistent feature of the market. And it's the structural reason why the house, the option sellers, always has an edge. So let me be absolutely clear. When you buy that call or that put, you're not just making a neutral bet on where a stock is going, you are knowingly buying a depreciating asset, an asset whose price has been artificially inflated by this fear premium. You are starting every single trade from a statistical hole. Okay, so if the math is so clearly stacked against you, why do so many people do it? The answer is simple. The game is specifically designed to exploit a deep-seated flaw in human psychology. It feeds on hope. Just think about your own trading for a second. Be honest. You see that call option trading for just a few pennies a share, and your mind immediately goes to the 1,000% gain, right? It feels like a smart bet. Low risk, massive potential reward. That feeling, that's the trap. You know, there's an academic term for this. It's called skewness preference. It's the exact same psychological quirk that makes people buy lottery tickets. You intuitively know the odds are terrible, but you overpay for that tiny chance of a life-changing payout. And the market makers, we understand this bias better than anyone. So here's how it plays out. You see the cheap out-of-the-money option. You start dreaming. But what you don't realize is that we, the dealers, have already priced your dream right into that option premium. We charge what's called a convenience yield. It's the price you pay for the convenience of hoping for a jackpot. And since we know the vast majority of those options will expire completely worthless, we systematically sell them to people like you, collecting those premiums funded entirely by your hope. You have to get this through your head. Your trade isn't really about the future of the company. It's a transaction where the product being sold is the thrill of a long shot. And it's a bet where the odds have already been tilted against you before you even sit down at the table. Now, this variance risk premium we've been talking about, it isn't just some abstract academic idea. For you, the buyer, it is a very real, non-negotiable, hidden tax that you pay on every single trade. This tax is buried in the price of the option through something called implied volatility, or IV. You've probably been told that IV is the market's expectation of future movement. That's a nice story. The reality? IV is the insurance premium the dealer is charging you to take the other side of your risky bet. Realized volatility, or RV, well, that's just what actually ends up happening in the real world. And if you look at decades of data, from academic studies by people like Carr and Wu to internal data on any professional desk, you'll see a persistent, undeniable gap. The price charged for volatility is almost always higher than the volatility that actually materializes. It's not an opinion, it's a statistical fact. That gap is the VRP. It is the dealer's profit margin, and for you, it is a built-in structural loss. It represents a direct, systematic transfer of wealth from option buyers to option sellers, day in and day out. But let's just imagine for a second that you get everything else right. You pick the right stock, you nail the direction, the move happens. You can still lose money. Why? Because you just walked right into the timing trap. This is what we call the volatility term structure. It's just a fancy graph showing implied volatility for different expiration dates. But here's the key. The research and the data all show that the shortest term options, yep, those weekly options everyone loves to trade, are consistently the most overpriced, the most inflated with that fear premium. I'm sure this has happened to you. It's one of the most frustrating things for a retail trader. You buy an option right before a big event like earnings, the announcement comes out, the stock does exactly what you wanted it to do, but your option's value is flat. Or maybe it's even down. This isn't a glitch in the matrix, it's a feature of the system. We call it vol crush. Here's how it works. Before the event, uncertainty is at a maximum. So that implied volatility, the insurance premium, on that short-term option is absolutely sky high. The very second the news hits the wire, what happens? All that uncertainty disappears. Poof, it's gone. And that front-end IV collapses, just violently. It vaporizes the premium you paid for that uncertainty, and in many cases, it completely wipes out any profit you would have made from the stock's move. You didn't just lose, you fell off the term structure cliff. All right, so if all of that wasn't enough to contend with, there's one final force working against you. It's not some abstract market principle. It's the dealer. It's us, actively hedging our books in a way that directly opposes your trade. Think about it from our perspective. You buy a call option. That means we, the dealer, are now short that call. We don't want to bet on direction. That's your game. Our game is to collect the premium. So as the stock starts to rise and your option gains value, our risk increases. To neutralize that risk, to stay delta neutral, we are forced to sell the underlying stock against your position. Let that sink in for a moment. The very structure of the market means that the entity that sold you the option now has a mechanical obligation to create selling pressure that suppresses the exact move you need to happen. It's like you're trying to run up an escalator that is programmed to start moving down the moment you step on it. So, what's the real takeaway here? It's that you've been conditioned to play the wrong game entirely. You're not just using the wrong strategy, you're asking the wrong questions from the very beginning. The amateur asks, will the stock go up or will the stock go down? It's a coin flip, really, and it's a question that dangerously ignores the most critical variable of all, the price of the bet itself. The professional asks a completely different question. We ask, is the price fair? Is the variance risk premium, the insurance premium baked into this option, so ridiculously inflated that even if I'm right on direction, I'm still overpaying? That is the only question that matters. It's not about predicting the future, it's about pricing the risk. At the end of the day, you have to understand that the options market is the largest insurance company on earth. Every single day, millions of policyholders line up to pay their premiums, either for protection or for the dream of a jackpot. And every day, the underwriters, people like me, we sit on the other side and we collect those premiums, confident that the laws of mathematics are on our side. You have a choice. You can continue to be the policyholder, or you can start thinking like the underwriter.